This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. Today we are joined by Professor Jay Ritter. And this is another one of those instances where I'd read so much of his research and found myself going back to his university webpage with all of his data on it so often that I don't know why it takes me such a long time to realize that I should just ask these people to come on the podcast, but it's the same kind of thing where it's like eventually I'm on his webpage for the fourth time that day and I'm like, I should just ask Professor Ritter to come on the podcast. And as seems to happen, I sent him an email and he responded and was more than happy to come on the podcast to talk about his research. So that was the genesis. And I think that I look back on the conversation we had with Lubosh as being extremely memorable and insightful. And this was the same kind of thing.
He was so interesting. We could have talked to him for another hour easily. Like the questions that just keep coming, coming to your mind as this conversation went on. It was so good.
And Professor Ritter's thing, like his main research focus, is IPOs, including SPACs, just the whole process of taking a company public. So we talked about IPOs, we talked about SPACs, but his command of the data and the theory as it applies to IPOs is just, and the mechanics too, like the whole process is just phenomenal. And then of course we touched on the paper. People might remember the podcast episode and the Common Sense Investing video that we did on economic growth versus stock returns. That whole idea came from his research. That was the inspiration. That does economic growth predict stock returns? The answer is no. It's actually negatively correlated. That originated from Jay Ritter.
Amazing. So Jay Ritter, also known as Mr. IPO, pardon me, is the Joseph B. Cordell Eminent Scholar Chair at the University of Florida, Warrington College of Business. He also has a BA and MA in economics and a PhD in economics and finance from the University of Chicago.
And he's a Chicago grad, FAMA student. And his wait to hear his response to the question on whether markets are efficient or not, and it comes up throughout the conversation implicitly too.
Yeah, and he's a really nice guy. So with that, we hope you enjoy our conversation with Professor Jay Ritter. And
last thing, real quick, he hikes in Canada. He and his wife travel to Canada in the summers. And something that jumped out at me as impressive and relevant to our Canadian audience is that he, for all of the data that he's able to spit out about IPOs, he's able to speak to Canada. So for every point he makes, he said, or most points, he was able to say,
he did.
Here's what it looks like in the US. Here's what it looks like in Canada. And I, as a Canadian, I appreciated that.
Yeah, he knew the data. It was very good.
Yeah. All right. So we'll go ahead to our excellent conversation with Professor Jay Ritter. Professor Jay Ritter, welcome to the Rational Reminder Podcast.
Pleasure to be here.
Professor Ritter, what do we know about the long-run returns of IPOs measured at the close of the first trading day?
In both the US and Canada, on average, they underperform over the next year or 3 years. But importantly, it tends to be that the tiniest companies have the underperformance. The bigger companies, on average, neither outperform nor underperform.
Are those returns different across different industries? Is there any sort of correlation there?
Well, for any given time period, some industries are going to do better than others. For instance, in recent years, the energy sector has done very poor. Historically, however, tech stocks have done very well. And not only for recent IPOs, but for the tech sector in general. 40 years ago, I don't think any of us knew just how big and important in the economy the tech sector would be. And indeed, 41 years ago, as we speak, the energy sector was pretty much at its all-time high in terms of the proportion of market cap around the world. Over the last 40 years, the energy sector has underperformed relative to the tech sector.
Interesting. Now, venture capital tends to play a pretty large role in technology companies. Are IPO returns different for venture-backed and non-venture-backed IPOs?
That has varied over time. In the 80s and 90s, that was the case. Since then, it has not been the case. But on the other hand, the last 20 years, there have been very few tech IPOs that have not been venture capital backed. Back in the 1980s and 90s, there were a fair number of small startups that went public that did not have professional financial sponsors. But that's been increasingly rare, where kind of the method for building a company has been kind of institutionalized, where it's incredibly rare now for any startup that has a plan to get big to not bring in both the capital and the advice that venture capitalists bring in.
This is fascinating. So, I mean, so far we've talked about IPO returns on average not being so good, but if you split it out by company size, if you split it out by industry, it's not obvious that it's you can't make a blanket statement that investing in IPOs is a bad idea. Is that correct?
Correct. The one thing that is worth looking at, however, is valuations. For instance, in the internet bubble, a lot of tech companies went public that crashed and burned. The valuations were just so high that it was difficult for public market investors to earn a decent return on a point forward basis. The last couple of years, people have been raising that same concern. In particular, in the last 12 months, the average or the median price to sales ratio of tech companies has been almost as high as during the internet bubble.
Wow.
Historically, the average price to sales ratio of tech companies going public in the US has been about 6. In 2018 and 2019, that ratio almost doubled to about 12. The last 12 months, it's been about 24. So when investors are buying in at a multiple that already reflects very optimistic expectations, the upside potential is more limited and the downside potential is greater. The company has to meet those very optimistic expectations in order to deliver. But there's a reason that investors are willing to pay the higher multiples. Partly tech stocks have done very well. And also the market doesn't view every tech stock as the same. Some have more defensible niches with a moat. There are network effects for some, and others are in more competitive industries where it's difficult for the company to grow and have high profit margins without competition eroding those profit margins.
Well, what about companies with negative earnings? Like, again, when we think about tech, so many companies go public that aren't generating a profit. Does that have a relationship with IPO performance?
For tech stocks, there hasn't been a very strong relationship between pre-IPO profitability and subsequent performance. The market is definitely focusing on growth, and in spite of what you hear all the time about the market being so focused on quarterly earnings per share, when you look at young companies, the market is telling them, don't focus on the short term. Focus on growth, gain market share, develop your business, and don't worry about short-term profitability. That said, at some point, a company does have to become profitable, and it varies by industry. In the restaurant business, the market is saying, if you're not profitable now, when are you going to be? the restaurant business is an incredibly competitive business where there aren't network effects. Competition comes in. On the other hand, with tech stocks, Facebook, Alphabet, Shopify, et cetera, there are those moats. And the market is correctly saying, don't worry about short-term profitability, gain that dominant market share, and the profits will come later.
What about skewness? I mean, we're talking about the market giving high valuations to these companies, and the companies you just mentioned, they've sort of come out as winner-take-all type companies. There must be a lot of other companies that had high valuations that didn't do so well. Do we see skewness in IPO returns?
Absolutely. And in general, the younger the company, the greater is that skewness. The higher the failure rate, but the possibility of big upside success. This is most extreme for venture capital investing in startups. And it's not unique to venture capital and the stock market. Book publishers, songwriters, movie producers realize that the most likely outcome is failure for any song or movie or book, but occasionally there's a blockbuster. They're counting on that skewness. Venture capitalists realize that the vast majority of startups they invest in are going to result in write-offs. But every once in a while, a Facebook or a Shopify comes along where the early stage investors earn enormous returns. For the venture capital investors, the limited partners, an extreme example is at the start of the internet bubble in 1998 and 1999, what at the time were the two most prominent venture capital firms, Kleiner Perkins and Sequoia Capital in Silicon Valley, raised $500 million funds. And they invested most of that money in private companies at the peak of the internet bubble, and almost all of them wound up as write-offs. But they each put $25 million of that $500 million fund in a startup search engine called Google. That one investment produced such high returns that the limited partners made many multiples of their investment, even though 95% of the money basically got wasted.
Oh.
That is such an interesting story. So with consideration for the skewness, do you think investors looking at IPOs and getting excited about investing in them on an individual basis, people should probably exercise quite a bit of caution?
Don't put all your eggs in one basket. It applies to all stocks, right, including IPOs. In Canada, the TSX Venture Exchange has had a similar experience to a lot of other exchanges around the world aimed at young companies, helping them raise capital, where the vast majority wind up being failures. Occasionally, there's a big success. But for the really tiny companies, on average, public market investors wind up disappointed. Not only the majority of the time, but on average, that investors seem to be buying lottery tickets, where just as with lottery tickets, the middleman takes a cut. And on average, as an investment, it produces a very low, perhaps negative return. And that seems to be the pattern pretty much around the world. If we think about a lot of the tech companies and other companies that have gone on to great success after being public companies, typically they did not go public at a real early stage. They had already demonstrated that they've got a product or service that consumers are willing to pay for. Many times they weren't profitable yet, but they did demonstrate that it was more than just a business concept.
So IPOs on average pop in price on their first day of trading, I guess indicating that the issue was underpriced. Why do IPOs so systematically get underpriced like that?
Well, this is a pattern that exists around the world. On average, the market price, once a stock starts trading, is above the offer price. It doesn't happen all the time. There are companies that sometimes drop on the first day of trading, typically only a little bit. And then there's some that jump a lot. In the vast majority go up just a little bit on the first day of trading. And this is especially true in Canada for TSX offerings, where Canada actually has less extreme underpricing than in most countries around the world. Basically, the IPO market in that respect works better in Canada than it does in the US. In the last year in the US, there's been a lot of extreme underpricing. The average first day return has been about 40%, which is the highest level since the internet bubble.
Really?
A lot of companies have shot up as we speak. Yesterday, Bumble went public and went up about 70% on the first day of trading. The company could have raised a lot more money if they had been able to sell shares at a price closer to that market price than the offer price that investment bankers had recommended. In general, underwriters and issuing firms realize that to get investors interested, they have to underprice the stock by a little bit. But that doesn't explain why some companies are underpriced as dramatically as they are. And I think partly what goes on is for a minority of companies, investor demand is really strong. And the underwriters take advantage of that. They know that the issuing company is going to be happy with the pleasant surprise, and they don't raise the offer price as much as they could. The issuing company is still happy. It was a successful IPO. They raised money, maybe raised more money than they could have or were expecting to. Their paper wealth of the employees and founders and financial backers is higher than they expected it to be. But the underwriters don't have the same incentives that the owners of the company have. The owners of the company benefit from a higher offer price. The underwriters benefit from a lower offer price. With most IPOs in the US and Canada, a procedure known as book building is used, where the underwriters ask institutional investors, what price are you willing to pay? How many shares do you want? And they find out about demand before they set the offer price. But if they find out that there's really strong demand, they don't raise the offer price as much as they could. There's then excess demand, and the underwriters are allowed to hand out shares to their preferred clients.
Wow.
Well, who are the preferred clients? The most profitable clients. How do you get to be a profitable client? Well, you overpay on other transactions. And so the underwriters have this incentive. If they underprice the deal, they induce their institutional investors, including hedge funds, to overpay on other transactions, which boost the profits of the underwriters. It doesn't help the issuing company, but it does help the underwriters. And that's where their interests are not aligned, where there's a conflict of interest between what's best for the underwriter and what's best for the issuing company.
Wow. Has the underpricing effect been constant over time, or has it changed?
The underpricing has not been constant over time. In the internet bubble, it was extreme. In the last year, in the US, it's been extreme. And these periods correspond to rising stock markets. They correspond to periods where the company might have formed its expectations about valuation and what offer price to expect at an early stage in the process. And then as the market has gone up, and especially if the market has gone up for that sector and that company, the issuing company and their shareholders are happy at the good luck of being there during a rising market. And because they're happy, they typically don't get upset if the underwriter leaves more money on the table than was necessary.
That's unreal. It's like a psychological arbitrage that the underwriter's taking advantage of, is what it sounds like.
I agree. In fact, Tim Loughran, a longtime co-author of mine, and I published a paper almost 20 years ago where we focused on the psychology of what goes on with the founders of the company and how they're happy to have a high paper wealth, even if the paper wealth could have been even higher.
Unreal.
Wow. So do individuals get much of an allocation to IPOs, or do most of the IPOs go to hedge funds and other very large clients, the brokerages?
It varies. With TSX Venture and very tiny offerings, typically they're distributed mainly to individual investors. For the bigger offerings, however, it's mainly allocated to institutional investors. As a rule of thumb in the United States, 90% of the shares in an IPO go to institutional investors,
Wow.
mutual funds, and hedge funds. In Canada, some of the big pension funds might get a little higher proportion.
And as an individual to get an allocation, I assume you have to be a client of the underwriting broker, correct?
In general, yes. And you have to be a profitable client in many cases. However, there's an additional danger. Sometimes the institutional demand is not real strong, and more shares are therefore available for allocation to retail investors. This happened when Facebook went public almost a decade ago. It was expected to be a hot offering, but institutional investors were getting concerned about whether Facebook would be able to monetize mobile users. As it turned out, Facebook has been able to do that, but it wasn't clear at the time. And they started getting hesitant about buying the shares. But there was very strong retail demand. And rather than 10% of the shares going to retail investors, 25% went to retail investors. One of those retail investors was me. I haven't bought all that many IPOs over the year, but I did ask with my discount brokerage account for shares in the Facebook offering. And I asked for 5,000 shares and was expecting to get 100. I got an email that morning saying I got 300. And I told my wife at breakfast, I'm not sure this is good news. It's
Wow.
good news that we got more shares than I was expecting, but maybe this is bad news in that it might reflect a lack of institutional demand. As it turned out, that was exactly the case. And during the next 6 months, the stock price fell by about 50%. Unfortunately, I sold for tax loss reasons and didn't hold on, where Facebook has then gone on to great success.
Fascinating. So there's adverse selection. If you as an individual can get access to an IPO allocation, it's probably not a good one.
There's a very big danger there. It's kind of the Groucho Marx theorem. Any club that's willing to accept me as a member is a club that I probably don't want to join.
Now, there have been, you mentioned a couple instances of lots of IPOs happening and massive underpricing. Like we mentioned, 2020 looks like it was similar. Do we know what causes these hot IPO markets?
There are a variety of issues, but actually, let me go back for a moment about the allocation to individuals. There's definitely an adverse selection problem, but if you do have a full service brokerage account, if you're a profitable customer, you might be one of those investors who does get favorable allocations. So if you've got a discount brokerage account, if you're paying nothing for commissions, then you've got to worry about adverse selection. If you are paying a broker for more hand-holding, you might not have to worry about this as much. Moving back to the question that you just asked about changes over time. Some periods there is very high underpricing of a lot of deals. In the last 12 months in the United States, there have been a lot of deals that have jumped in price. It continues to surprise me how long this has gone on. Many of them have been hot tech deals, but some of them have been in the healthcare sector, in particular with biopharmaceutical companies, where there's been a huge boom in that sector. Part of it has to do with the COVID-19 situation. But this is the 9th year in a row where the biopharmaceutical sector has been having a lot of companies going public. That sector has been doing quite well, partly because there have been some scientific breakthroughs. The old trial and error method of developing new drugs has been getting more efficient, and capital has been flowing into the industry, partly with venture capital funds investing, and partly with many of the companies then going public. And investors know that not only are most of these companies losing money, most of them have no revenue and no prospect of revenue from product sales from many years ahead. And in fact, investors know that most of them will never have a successful drug. But occasionally there will be a company where the science works out and they will have a blockbuster drug. In many cases, they will then sell out to a big pharmaceutical company at a premium price. And so investors are counting on skewness in the market for the biopharmaceutical companies.
Interesting. So do you think these IPO waves are related to technological advances? Like we're seeing all these tech IPOs and you're mentioning biopharm. Is that the causal relationship?
There's definitely a relationship between the underlying technology and the stock market. If we go back hundreds of years, Adam Smith's invisible hand theorem had capital flowing to its highest valued use. There's some industries that are advancing where capital is flowing in. Electric vehicles, autonomous vehicles are definitely sectors where there's advances going on, and investors are very excited about that. In the internet bubble, the internet was jumping ahead. Investors were very excited about it. What sometimes happens, though, is the valuations get ahead of the technology. What we find, not just in the IPO market, but there's a danger of investors chasing past returns. We saw this with the housing bubble. where in Spain, in Iceland, in the US, not so much in Canada, investors in the early 2000s were making a lot of money as real estate prices went up. And people then poured money into real estate, pushing the prices up even further. And the prices got too high and the bubble burst. In the internet bubble, that's what happened. Right now, with autonomous vehicles, electric vehicles, it's definitely an exciting area. Strong advances are being made in the technology. Everybody agrees that this is the future. The legacy auto companies, General Motors, Ford, Toyota, Volkswagen, they all agree that this is the future and that radical change is going on. But what's the right price? I should acknowledge I am short in Tesla.
Still, I heard you. Okay. I was going to ask
so
about
far,
that.
it's been money losing for me. A little over 2 years ago, I bought a Tesla Model S. I've been kind of disappointed. The autopilot doesn't work as well as I had expected it to. The improvements are slower than I had expected. I get these online updates. Most of the time, they're adding a new video game that I can play while the car is in park. The autopilot hasn't been improving very much. So the change is occurring less quickly than I had expected it would. There's definitely improvements being made. Cars are getting safer. And electric vehicle technology, battery technology is getting better. But, there's a price at which it's a fair price where the expected returns on a point forward basis are consistent with the market. And there's a price at which the price has gotten too high and expected returns are going to be lower.
So that leads perfectly to my next question. Do hot IPO markets tell us anything about expected returns going forward?
Yes. On average, the hot markets have been followed by lower returns. But as with all things, whether it's real estate, whether it's the fixed income market bonds, whether it's with stocks, calling the turning points is always difficult. In recent years, interest rates have dropped and continued to drop. And that has surprised just about everybody how low interest rates have gotten worldwide in both real terms and nominal terms. Is it going to go on forever, the continued drops? No, but where's the turning point going to be? None of us know. Same with the stock market and electric vehicles. With Tesla, I thought the stock was overvalued before it went up another 800%. I wish I had been better on that market timing.
I heard you on a podcast in 2019 where you talked about your short position in Tesla. So I was wondering if you still had it.
Well, actually, in March of this year, when the stock market had dropped, I did cover a little bit of the position, but then I have added to it since then. In particular, in December, when Tesla was added to the S&P 500 and it jumped dramatically. At the close on the day that it was added, I shorted additional shares. I was making the market more efficient. There was this demand from indexers. I was a supplier by shorting more shares. I thought that was likely to be the peak. So far, I've been wrong once again.
Would you say, we talked a little bit about the underpricing in 2020. Would you say 2020 was a hot IPO market?
Yes. The average underpricing was quite high. The volume of deals after falling off in the spring when the stock market around the world tanked. But nobody expected worldwide stock markets would come roaring back as much as they have, especially the tech sector. China and the US have had some of the biggest recoveries, especially in technology. And a lot of biotech and tech companies and other companies have taken advantage of that by tapping public markets. And the start of 2021, we're seeing very high levels of activity, that we haven't seen since the internet bubble.
Yeah, you mentioned that comparison. Anecdotally, this period feels the most like the late 90s, early 2000s to me, just in terms of dealing with retail clients. How do you compare this period to that period?
Well, there's a lot of investor enthusiasm, but one big difference between now and the internet bubble is in the internet bubble, lots of startup, very young companies were going public. Back then, the word was first mover advantage. They were all fighting to be the dominant player in some niche with the idea that there would be a winner-take-all situation. That's still the case in a lot of markets. But the big difference now is we're not seeing young startups going public. It's mainly companies that have been nurtured by venture capitalists for many years, where they've demonstrated, we've got a product that consumers, whether it's individuals or businesses, find worthwhile. And so the chance that the company is going to fail is dramatically lower because we've got more mature, older companies going public. But on the other hand, they're going public at very high valuations. The sales are higher, but the price to sales ratios are also very high. And so these companies are more likely to be winners, or in many cases, they'll eventually merge with some other company in the industry, but they probably won't be merging at fire sale prices. But on the other hand, when you go public at a $10 billion valuation, the upside potential is more limited than if you had gone public at a $100 million valuation.
So that raises another interesting question, which is that companies are going public later. We know that, kind of like what you're just describing. Fewer companies are going public than they have in the past, and there are fewer listed companies available in the stock market now. Do you think investors should be looking at getting exposure to private markets based on that?
The simple answer is no. Private markets aren't great for individual investors. We talked about adverse selection before. For individual investors, even if you're wealthy, getting into a venture capital fund or a private equity fund that's going to be able to find the Shopify or Google or Facebook is difficult. It's difficult for the VCs to know which companies are going to be successful. But while we've seen some big successes for some of these venture capital-backed companies, we don't read so much about all of the failures. And so it's important to look at averages. There's a study by Ludovic Phalippot of the University of Oxford's Business School that attracted a lot of attention this past year, where he calculated that since 2006, the average limited partner in venture capital and buyout funds has gotten an average return the same as they could have gotten by investing in publicly traded stocks. The fees that the middlemen collect are big. Indeed, he emphasized that the general partners have gotten rich whereas the average limited partner has done as well as if they had invested in publicly traded stocks. So I don't think it's the situation that individual investors are losing out on a great opportunity. It's also the case that most of the investors in these private funds are not individuals. They're pension funds, endowments, those are the main institutional investors. And so individuals are getting the benefits indirectly through those investments. So I don't think there's any great missed opportunity for individuals. Of course, some funds are going to do really well, but others will be disappointing. But also, if we think about what we'd expect to see, this isn't a surprise that the limited partners haven't been earning abnormally high returns. If this sector was offering great opportunities, more money would flow into it, and that extra money would push up the prices that the VCs and the private equity firms have to pay, lowering the returns that their investors are going to get. And I think that's exactly what's gone on. So much money has poured in that it's difficult for them to find a company and buy into it at a really low valuation.
So another topic that is getting a ton of attention lately are these SPACs, special purpose acquisition companies, or blank check companies. So we have a bunch of questions on them, but to kick it off, can you describe what a SPAC is?
A SPAC is a company that's modeled after Canada's capital pool companies, where they conduct an IPO, raise cash, and that money is put into an escrow fund. So the middlemen, the founders of the SPAC, known as the sponsor, they don't get that money. Instead, it goes to a third party with a money-back guarantee for those investors. And then the SPAC sponsor goes out, and typically they've got an 18-month or a 2-year horizon, which is specified in the IPO contract, where they have to find a company, almost always a private company, to merge with. And importantly, the public market shareholders have to vote to approve the merger. If they don't, the investors have the right to get their money back with interest. And so the downside risk for the SPAC investors is non-existent, but there's upside potential. The typical SPAC sells a unit that is composed of a share plus a warrant to buy another fraction of a share. And the share portion of that unit has this money-back guarantee. And so essentially the SPAC IPO investors are getting a free warrant. This is a great deal for the SPAC IPO investors. Now, how valuable that warrant will be depends upon, is the SPAC able to find a good company to merge with and negotiate deal terms that make it favorable for the SPAC investors. Until 2 years ago, or a little over a year ago, the SPAC market was not all that big. Typical year, maybe 50 SPACs went public, raised maybe $5 billion, maybe a little bit more.
Yep.
But last year, the SPAC market exploded. 248 SPACs went public in the US, raising about $80 billion. Yeah. And this year, that explosion has gotten even bigger. We're seeing so far this year over 20 SPACs per week going public, an annualized pace of 1,000, and raising more and more money. So, and the SPAC prices are jumping on the first day of trading and going up in many cases beyond that. And in many cases, when a merger is announced, jumping even more. There is a danger that so much money is there now chasing the operating companies to do a merger, that the operating companies are in a great bargaining position. If they've got 5 SPACs that all want to do a merger with them, they can play them off against each other. And the operating company might find this is a better way for us to go public. If the merger occurs, this private company will now be a public company, having merged with the publicly traded SPAC.
So a SPAC price could go up once it goes public, even though it doesn't own an operating company yet.
Yes, indeed, what's been happening this year and starting at the beginning of last year is on the first day of trading, the price has been jumping. Every single SPAC that has gone up, that has gone public since November has gone up in price on the first day of trading, like 180 out of 180. Some of them have only gone up by a tiny bit. Others have gone up by 10 or even 15% on the first day of trading. So for investors, mainly hedge funds that buy at the offer price, they no longer have to wait. If they want to sell the unit right away, they can pocket that first day return. Now, it's not as big on average as for operating companies. This year for SPACs, the average first day jump has been 6%, whereas it's been 35% for operating companies. But with this, if you're an ordinary investor like me, you can buy in once it has started to trade at, on average, $10.60 per share. They almost always go public at 10. There's still upside potential, although now potentially I could lose 60 cents. But on average, they have continued to go up in the market after that.
What's in it for the promoter to launch a SPAC?
Well, the SPAC promoter typically keeps 20% of the shares. So the SPAC is selling 80% to the public, and that money goes into an escrow account, and the SPAC keeps, the SPAC promoters keep 20% of the shares for free. So they're getting 20% of the company for free. Now, it's actually a little more complicated than that. They typically buy warrants at the time of the IPO, where they're typically paying $5 or $10 million for that.
Okay.
So they are putting in $5 or $10 million of their own company, of their own money into the company. And if they don't find a successful merger partner, they lose all of that.
Okay.
On the other hand, if they do find a successful merger partner and the shareholders approve and it does well, it can be very lucrative for the SPACs. But of this $5 or $10 million they're putting in, part of that goes to pay the expenses of finding an operating company to merge with. And part of it goes to pay some of the investment banking fees. So when the SPAC goes public at 10, underwriters typically take 2% upfront as a fee. So there's only $9.80 per share. But the sponsor typically tops that up by putting in an extra 20 cents out of their own pocket, so that the investors that put in $10 are going to get $10 plus interest. There's no downside risk at all for them. In return, then the sponsor has some money at risk. They've also got the upside potential, so they've got good incentives to try and find a successful merger partner, and Some of the, just as with other mergers between one operating company and another, some of them then work out, others don't.
But you're really relying on the promoter to find a great operating company, because if it goes public, correct me if I'm wrong, at say $10, the price goes up to $12, and the promoter gets 20% warrants, there's a lot of dilution that's going on there. So they have to get a very good company to justify the valuations. Am I accurate in that?
Yes, there is that dilution cost. The public market investors are putting in 10, but the SPAC then only has $8 in cash per share because the only 80% of the stock was sold. So the SPAC sponsor does have to find a merger partner and negotiate a deal that's attractive enough to cover that 20% dilution. And sometimes the SPAC sponsor then puts in additional cash, buying additional shares at $10 each. Yep. Typically that's done at the time of the merger. Sometimes they also find another investor to invest at the time of the merger, putting in additional cash. That's typically called a PIPE investor, private investor in public equity. So the SPAC might raise $200 million. At the time of the merger, they might get another $100 million put in. And so they've actually got $300 million to give the operating company. And it's just as if the operating company had gone public and raised $300 million in the merger. Now, the operating company, in deciding who to merge with, they frequently do pay attention to, just like companies looking for venture capital funding look at, well, who are these people? Mm-hmm. Do they have industry expertise? Can they offer advice that's going to make us a more valuable company? So a SPAC that has sponsors that have been successful executives in a given industry generally has more success at finding a good merger partner and negotiating a good deal, because in addition to offering cash, they can offer quality advice to the company as well.
Interesting. There's a bit of a narrative out there, probably maybe coming from SPAC promoters, that SPACs are sort of a cure to high IPO costs and the underpricing issue that we've talked about. Are SPACs a better route for going public than the traditional route?
The simple answer is maybe. We see lots of operating companies going public. We also see lots of SPAC IPOs, and we see mergers from SPACs the last 2 years occurring. So it looks like there's not one size fits all, that all of these things are going on. And at the same time, there are also some companies doing direct listings where they bypass both traditional IPOs and SPAC mergers and list their shares directly on the stock market, bypassing those middlemen. So with both traditional IPOs, where money left on the table causes dilution to the pre-IPO shareholders, with a SPAC, both for the IPO investors and for the operating company, there's dilution due to the SPAC sponsor shares. And in any given deal, the costs and benefits might be higher with a traditional IPO than with a SPAC merger, or vice versa. It doesn't seem that one size fits all.
Are there any unique risks people should be aware of with SPACs?
Well, for the IPO investor or buying before a merger has been announced, you do have to pay attention to that announcement. There is a danger if other investors don't think the merger is all that great, that they ask for their money back, and the SPAC has a problem. We don't have the money to complete the merger. And if you're not paying attention and don't ask for your money back, you might be left holding shares that are worth less than $10. So it is something that you have to pay attention to. And if you're buying in the market at $10.60 or $11 or $12, there is the possibility that you're going to lose if a merger occurs, but the stock price winds up being only worth $10.10 and you bought at 12, you've lost that. And furthermore, after the merger occurs, sometimes the deal doesn't work out and the stock price might decline to $1 a share and you've lost 90% or more. On the other hand, maybe you were lucky enough and your SPAC invested in DraftKings and the price has gone up twofold, threefold, fourfold, and you made hundreds of percent on your investment.
It sounds like we're in a bit of a different SPAC market just with the volume. But if we look at the historical data, how have SPACs performed historically for investors?
Well, historically, for the IPO investors, it's been a great deal. If you bought at the IPO or in the market at a tiny premium and held it until a merger was completed or you got your money back, on average, investors have earned 9.3% per year with no downside risk.
Wow.
The worst deal still produced a positive return because of the interest earned on that escrow account. 9.3% on a risk-free investment has been great. But for the post-merger period, sometimes called the de-SPAC period, because it's no longer a SPAC, now it's just a company that's publicly traded. On average, in the past, deals have underperformed the market. But we have to be a little careful with that, in that recently the average deal has done very well. And also, historically, if at the time of the merger announcement, investors haven't been very enthusiastic, most investors have redeemed. And those are the deals that typically have done worse. And since most investors redeemed, there weren't many investors left who lost money. So if we weight by how much cash was there, the returns haven't been great, but they've been better than if we ignore the fact that the good deals, investors leave their money in, and the bad deals, they take their money out. But as I mentioned, in recent months, things have been great. So using that historical average when there weren't all that many deals, the numbers look worse than if we take into account what's happened recently. But have the recent good performances been because there's a bubble going on, which won't continue in the future? That remains to be seen. I do have concerns with so many SPACs going public and so many SPACs chasing deals that they're going to be in a situation where it's harder and harder to find a good deal. So on a point forward basis, some of the deals will do well, others won't. I'm not sure what the average is going to be.
You mentioned the 9% effectively risk-free investment for historical IPO SPAC investors. Do you think that's going to be different going forward just because of the amount of SPACs and the pricing?
Well, historically, they didn't jump on the first day of trading. So even a retail investor like me could buy in at just a tiny bit above $10. And so my returns could be as good as for the hedge funds. Indeed, I wish I had started doing this earlier, but last year I started buying SPACs right after they went public. And they've done very well for me in recent months. But now that the prices typically jump on the first day of trading, I've stopped buying. I think that there's still some upside potential, and there's still relatively good deals compared with just having your money in the bank, but the free lunch isn't as big as it had been. It's also the case that, while on average recently they've been jumping up 6% on the first day of trading, some go up 1 or 2%, others go up 10 or 15%. Partly that difference is based upon the quality of the management team that the sponsor has. And partly it's based upon the details of the SPAC unit itself. Some of the units offer a share plus a warrant to buy a full share. Others offer a share plus no warrants at all, or a warrant to buy 1/8 of a share. Well, a warrant to buy 1/8 of a share isn't worth as much as a warrant to buy a full share or a half share. And so paying attention to the quality of the management team and paying attention to how much the warrant is giving you also matters.
So that just made me think of, I've seen some SPAC ETFs where you can just participate in all of the SPACs effectively with an index fund-like approach. But based on what you're saying about needing to pay attention, that sounds like it might not be the best idea.
Well, the SPAC ETFs, including Joseph Schuster's SPAC ETF, have done incredibly well in recent months. But as we talked about before, chasing past returns can sometimes not work out too well for investors. And nobody expects the returns in the future to be on average as high as they have been the last couple of months. For one thing, the stock market has gone up. Secondly, there's been this increased enthusiasm for SPACs, and a number of the merger deals have been very attractive. So I think there is a danger of chasing those past returns, but it's entirely conceivable that in the next couple of months, the SPAC ETFs will continue to do very well.
So I think we can move on from SPACs. It is so fascinating. So one of the questions I've been most looking forward to asking you has to do with countries that have high economic growth. And many people assume that's the best place to invest based on that expected growth. Is that necessarily true from the data?
This is shifting off the topic of IPOs, but I have published some articles over the years that look at the long-term returns in different countries. The average return in Canada versus the average return in Brazil, and the economic growth rate in the country, and in particular focusing on per capita economic growth. This analysis is based upon work that was first done by Dimson, Marsh, and Staunton, some at the time London Business School professors, who published a book 20 years ago about the previous century's return, where they found around the world, surprisingly, that there was, if anything, a negative relation between a country's long-term per capita inflation-adjusted economic growth and inflation-adjusted stock returns. That the countries with the best economic growth per capita didn't necessarily have the best stock returns. In particular, something that nobody guesses at, in terms of stock markets that existed 120 years ago, what would have been the best country to invest in? And I'll pause for a second to let everybody think about the country that they think would have been the best to invest in. None of you would have guessed South Africa. South Africa is not a rich country today. It's not the poorest of the poor. But it actually has been, over the last 120 years, the best country to have invested in publicly traded stocks, even though the standards of living have increased by fairly modest amounts compared with some other places. China has certainly had huge economic growth over the last 31 years since their stock market reopened. But China has not been the best emerging market to invest in. Indeed, over 120 years, the best markets to have invested in have been South Africa, Canada, the US, Sweden, Australia. These have a few things in common. One is almost all of them are English-speaking countries that have British legal systems as kind of the dominant legal system. They've all been fortunate to not having had a war fought on their territory during that time. But in particular, when we look around the world, Japan was a really poor country 120 years ago. It's a rich country today, but it hasn't been the best place to invest for stocks. The last 31 years since the bubble burst at the very end of 1989 in Japan, Japanese equities have produced negative returns. China has produced lower returns than Mexico over the last 20 or 30 years, even though Mexico's per capita growth rate has been actually, even among emerging markets, fairly low. And China has obviously been very high. So what explains this lack of relation between economic growth and stock returns? Well, partly you have to pay attention to the price-earnings ratios. South Africa historically has had fairly low price-earnings ratios. So, and it's also had high dividend yields. We tend to forget this, in that the last couple of years, the last couple of decades, capital gains have been more important than dividend yields. But historically, high dividend yields have produced high returns. And I don't think that's been eliminated. If a company doesn't produce profits, its stock isn't going to do well in the long run. But what produces profits? Well, a country's profits can grow without a company's profits growing. When you're investing in the stock market, you're investing in the company's per share profit growth. And China is an example of a country where the stock market has grown by a lot, the economy has grown by a lot, but per share earnings have not grown by a lot. China's stock market has mainly grown due to more companies going public without the stock prices of individual companies going up by a lot. Now, there are some companies that have done very well, Alibaba, Tencent, but actually Alibaba went public in the US. Tencent went public in Hong Kong. Domestic investors in China weren't permitted to invest in those companies. The most valuable company in China is a liquor company, Moutai. I think nobody would have predicted 20 years ago that would have been the best company to invest in China. But we see in many cases a country is able to grow dramatically without the earnings per share of the incumbent companies growing by as much as the economy grows.
Do you think that relationship holds at the industry level? If we have an industry that's going through enormous growth, like we talked about electric vehicles earlier, that kind of thing where there's a big technological advancement, the industry is set to grow massively, does that lead to higher stock returns for the industry?
In many cases, yes. But importantly, getting in early rather than buying in at the peak is important. And on average, people are buying in at the peak. With tech, a lot of the biggest market cap companies today, all of the biggest market cap companies today did not start out as the biggest. Now, whether we're looking at Shopify or Microsoft or Apple, Amazon, Alphabet, Facebook, most, although not all of them, went public when they were profitable and already pretty big companies. Amazon.com was an exception. They went public at a pretty early stage and took many, many years to become profitable because they were focusing on growth for so many years. And today they make most of their money from the cloud, something that wasn't even in their thoughts when they went public in 1997. For investors who are buying in today, it's difficult to know which are the industries that are going to be the dominant industries of tomorrow. Certainly tech will be big, but tech is already big.
And do you think that, like you mentioned at the country level, if a country's growing a lot, its profits the country's overall profits can grow, but if that's happening through lots of new companies and the earnings per share is not growing, that can lead to poor stock returns. Could we see the same thing at the industry level?
That's indeed possible. If we go back to 1980, the energy industry was the biggest sector of market cap in the world. And oil prices had gone up tremendously in the previous decade. Alberta was a huge beneficiary of that. And people were projecting that oil prices would continue going up forever. It hasn't worked out that way. With tech, maybe it's different because we do have some of these winner-take-all situations where some companies can continue to achieve very big profit margins without competition eroding those margins. But that doesn't mean that the tech sector will continue to be growing market share. And how we define the tech sector has changed over time as well. In Canada, banks are a very big fraction of market cap. For many decades, people in the banking industry have said, what is the banking industry? Well, they're IT companies that happen to be dealing with money. But information technology spending is a really important part of banks, to prevent fraud, to make efficient decisions, to decide what interest rate to charge and what the credit limit should be on credit cards, et cetera. There's an awful lot of technology there, and yet there is the fintech sector. But if we look at the IT spending of banks, they could also be classified as tech firms.
Right. Professor Ritter, I want to finish off with a couple of questions stemming from a paper that you wrote titled The Biggest Mistakes We Teach, where you kind of took a bunch of generally accepted ideas in finance and you basically ripped them apart, which is something that I love. Similar to the paper that we just talked about with economic growth versus stock returns. That paper was hugely influential to me, as I'm sure it was to many people. When investors are planning for the future, How do you what do you think they should use for an expected future stock return or an expected equity risk premium?
I'm a big fan of the Shiller price earnings ratio, the cyclically adjusted price earnings ratio, CAPE, or sometimes called the Shiller price earnings ratio. If we flip the price earnings ratio, we get the earnings yield, earnings over price. And what Shiller has done is he uses the 10-year average earnings of the S&P 500 and divides it by the current level of the S&P. And he uses that 10-year average to adjust for business cycles. Profits today might be higher or lower than average, but over a 10-year average, it kind of averages out. And this has become increasingly popular for good reason as a measure of the expected real long-run return on stocks on a point-forward basis. And today, that number is down to about 3%. The expected real return on stocks is only about 3%. Now, he's using US data, but to the degree that investors have a choice about what market to invest in, those international capital flows would lead one to expect that the expected returns ought to be about the same everywhere.
Oh,
so
wow.
the expected returns on stocks are not real high in inflation-adjusted terms, but the expected returns on all asset classes are low today because interest rates are so low. The inflation-adjusted bond yield for 10-year bonds, TIPS, Treasury inflation-protected securities, is about minus 100 basis points. So the difference between the 3% expected return on stocks and the minus 1% expected return on risk-free bonds is about 4%. That number has actually been amazingly constant over the last decade. And in the internet bubble, inflation index bonds were yielding 4%, and the Shiller price earnings ratio was predicting a yield of about 3%. So that equity risk premium, the difference, was minus 1%. Stocks had expected returns lower than bonds, which is one of the reasons why I was out of the market at that time, out of the stock market. But just like Shiller, I got out a little too early, and when to get back in is always a question. But today, given that the expected returns on all assets, whether it's real estate, bonds, equities, are low, while stock expected returns are low, I still think that having a diversified portfolio that includes all asset classes, including stocks, is a good idea for most investors.
I just want to touch on something that you mentioned there. Like you said, when you look at the US CAPE, expected stock returns look very low. But if you look at emerging markets or Canada or international developed, it doesn't look so bad. But you said that the expected returns are probably the same. Can you elaborate on that? Because that's a little bit mind-blowing.
Well, they're not going to be exactly the same, but investors do have a choice. Especially if you live in countries like Canada or the US, where there aren't restrictions on capital flows like China has. We can have a choice of how much to invest domestically, how much to invest internationally, how much to invest in a specific market. In the last decade, the US has had really high returns. But that doesn't mean that will be true in the future compared with other countries. I continue to remain internationally diversified. Over the last decade, that's been a drag on my portfolio returns. But on a point forward basis, I'm fully comfortable being internationally diversified.
Interesting. Okay. I understand. All right. My last question. before we get to our last question, you're a Chicago graduate, and we've talked about a few things that you're doing in your own investment accounts, like shorting Tesla and investing in SPACs. So I have to ask, is the stock market efficient?
Yes and no. As one of my former professors, Eugene Fama, has said, all models are wrong, but some are useful. The efficient markets hypothesis can be a useful way of thinking about things, but that doesn't mean that it's perfectly correct. I wouldn't be shorting Tesla if I thought that the stock market was completely efficient. During the internet bubble period, I thought tech stocks were ridiculously overvalued. There was 100% certainty in my mind that a bubble was going on. And I was right. I didn't know when the turning point would be, just like today. Nobody knows where the turning points will be. But a problem for most individuals when they try and time the market is they do things exactly wrong. People tend to chase past returns. So they invest in real estate after real estate prices have gone up. They invest in tech stocks after tech stocks have gone up. Maybe they'll continue to go up for a while. But on average, chasing past returns has proven to be the wrong strategy. But that's the strategy that most investors follow.
Right.
What a great answer. And I get the privilege of asking the last question, which is often a listener favorite. How do you define success in your life?
There's more than one way to define it. I don't view it as one size fits all. There's professional success, there's personal success. Money isn't everything. Health is probably the most important thing. One thing I would say, though, is looking back, or if you're younger, looking forward, being able to think ahead and ask yourself, of the people that I've interacted with in my job, in my personal life, family, friends, how many of them have walked away thinking this person is a jerk? If you can rationally say, just about everybody considers me a nice person. I would view that as a big measure of success that's under your control.
It's a great way to think about it.
Terrific answer. This has been an incredible interview, and certainly I think we will all agree this has been very nice of you to join us and some great information. Thank you so much, Professor.
You're very welcome. And just one last comment. I live in Florida, but my wife and I visit Canada every summer. This past year was an exception, but we, just as many snowbirds come to Florida, we take advantage of that seasonal weather change and take advantage of the great outdoors in many of the provinces of Canada. That's great. There's some, I know you hike, and there's some beautiful hiking, as you know, in Canada, which I also enjoy as much as I can. Yes. Thank you very much.